I'd like to welcome everyone today to our third quarter review from Sendero Wealth Management. Joining myself, John Roselle, the Chief Investment Officer at Sendero, we have Amory Conti, who is the Director of Research for Sendero and manages a number of our portfolios. We have Rodrigo Lopez, who's our Director of Due Diligence. And then we're honored to have two of our advisory board members with us today. Patrick Kennery, who focuses on the macro side of the investment landscape, and Thano Hasiotis, who focuses on equities and equity markets. So let me just start this off by saying it's been a turbulent year. But Amory, can you review for our audience the bull-bear scenarios that we came out with at the beginning of the year, and just where have we landed currently?
Yeah, absolutely. So just to recap, we finished 2024 with the S&P 500 closing about 5,900. And I look back at previous kind of bull bears that we've done. And except for the first quarter of 2020, of course, this is the first year, meaning 2025 is the first year that we've actually gone through our base case, our bear case, and now our bull case. Entering 2025, if you remember, our expectations from a base case scenario were for muted returns for the S&P 500. The range that we had looked for is about 6,000 to about 6,200 on the S&P. Now, to put that in perspective, we had two 25 plus years in 2023 and 2024. So the rationale behind this is there's a lot of good news, the Trump 2.0 post the election, moderated headlines around tariffs and all that. Now we know, as we've gone through the first quarter, that we did hit the bear case, which was about 5,200, 5,400. A lot of that was driven, of course, by Liberation Day. I do want to point out, we also had a little bit of a scare around AI and capital spending, going back to the DeepSeek, scare out of China in kind of February, March timeframe. And then you kind of fast forward, April 9th, of course, the markets has a huge jump, and we really haven't looked back ever since. Now, the bull case that we had identified was not only more benign and targeted tariff scenarios, which it's really kind of playing out to be exactly that. Moderation in inflation, moderation in the labor market, and more importantly, a pickup in earnings growth, which again, from the first half of this year to now we're seeing is actually kind of being played out. I know Thano is going to talk about a little bit more of the dynamics within the market itself. So here we are, our bull case was 6,500 to 6,800, and as of today, we're about 6,700, so not too bad. And then the last thing I'll just mention on that is we also looking at the fixed income, and we use the 10-year treasury yield for that. We identified most of the range to be between 4 and 4.25 for the majority of 2025, and we're sitting at 409 today, between a scenario of the Fed cutting rate by 50 basis points, which was again our base case. Obviously, they've done 25. We'll see whether they do again in October and December, but looks like we're right on target. When it comes to what we talked about at the beginning of 2025.
Yeah, I would point out that that bull bear has a pretty big range associated, and when we set that, one of the things that we think about is we try to put probabilities around where the market can act, and that really sort of directs us to think about our investment strategy and our asset allocation. Because we want portfolios that are going to be robust in either of those extremes from that standpoint to be able to really deliver for our clients. Rodrigo, can you tell us a little bit about what's worked in the portfolios this year and where we've seen some challenges.
Yeah, and I'll walk through performance using our usual three broad asset classes. But like John, I like what you said there because our job is to build portfolios that are resilient in different market environments. So in stability, for the first time in a while, we've seen very good, strong, positive performance in taxable fixed income. We've seen a nice performance tailwind in yield and total return. Clients which should have experienced performance in the 6 to 8% return range for the year closing this third quarter, and then closer to 5% in municipal fixed income or tax exempt fixed income, which is quite attractive, especially as we came out of the 2022 drawdown, which is the quite painful in client portfolios. In growth, we see and we continue to see public equities being dominated by two themes. The first is the AI trade, which is still alive and well even after the drawdown in April. And then the international mean reversion trade, where we've seen international equities for the first time in a while really outperforming. It's been really the first time in about 15 years where we see opportunities being discovered and favored in emerging markets as well. And then this dispersion has proven to be very fertile ground for strategies like hedge funds in equities and in credit as opportunities have presented themselves on both sides of the return spectrum. And then just to wrap up, what we continue to see is managers either taking advantage of mean reversion trades and AI trades, but we also see managers, especially in US value, which has lagged this year, batting down the hatches, getting more defensive, buying into names that have been out of favor this year. And that all plays to the barbell of exposures in client portfolios where we want these and we like to see these work in different time periods and in different market environments.
Thank you. That's most helpful. Let's turn to Patrick briefly, and I'll just give a brief introduction to Patrick Kennery. Patrick has been serving as an advisor to us for probably about 6 to 7 years now. Previously, he was the chief investment officer at Teal Capital, which was Peter Thiel's macro investment firm. And so he comes from a strong pedigree of contrarian thinking, I would say, probably best in the macro environment. So with that introduction, Patrick, why don't you talk to us a little bit about some of the themes and some of the underlying conditions from a macro environment you're seeing? We've certainly seen it to be a volatile year, and there's been a lot of noise, and we expected, I think, a lot of noise with this new administration, but there's still some very pertinent themes that are starting to come through and express themselves.
So first, I guess I'd say sometimes I am contrarian, but it doesn't pay to just be reflexively contrarian. I think what you look for are things people are maybe not paying attention to or not really discounting that actually have a decent probability. And so one that I want to talk about, and this is not to say that this is the most likely scenario, but it's one that has not gotten a lot of attention or given a lot of credence in terms of probabilities. And so the best case for markets historically has been what people refer to as a soft landing. And that's where the Fed, the economy is overheating in some way. And so the Fed raises rates fairly aggressively, but they manage to slow the economy down without having a recession. And it's almost like a rare bird. The people are always hoping and looking for it, but in the last 50 or so years, the only time that that's occurred has been 1995. And if you were to look at a chart, you can just track the Federal Reserve target rate, so where they're pegging their interest rate alongside GDP. And in every one of the large rate hike cycles that they went through, it was followed by a recession, except for 1995. So there was a large rate hike cycle in 1994. The economy slowed down in 1995, but did not have a recession. And if you look at what happened in the stock market, then it was one of the best risk-adjusted years, possibly the best risk-adjusted years, again, in the last at least 50 years. The stock market was up something like 34%, and it was very low volatility. Every month made a higher high and a higher low. And so to me, is to think about like what would be the conditions that you would need to get that kind of situation. And just to preface this is that this is not to say that right now is that similar to 1995. It's just a good anchoring point of what was going on then. In 1995, probably the biggest difference is demographically, the US was very different because the baby boomers were reaching sort of peak spending mid to late 40s in their life cycle. Now, most of the baby boomers are retired. So we can't assume that we're going to have the same economic conditions as them. But I think it's a good way to think about the relationship between growth, inflation, and stock market performance. So if you look at what happened in 1995, inflation and GDP growth slowed considerably. There was some concern that we would fall into a recession, but we didn't, and that propelled stocks higher as rates fell considerably, but not reflecting recession conditions. So if you roll forward to today, and John mentioned the volatility and noise that we've seen this year, I think a lot of that is the residue of the inflation cycle that we saw in 2022 and 2023, and the Fed rate hikes over 2022 and 23 that really put markets on their back foot and raised a lot of concerns that the inflation would be persistent and would force the Fed to do even more, and which might in fact force us into a recession. So in order to kind of put that behind us, which was frankly the biggest driver of volatility, we have to put inflation behind us. It no longer has to be the main concern for markets. And I'd say that inflation is still something the Fed is talking about it a lot. Lots of people on Wall Street are talking about it a lot. But there are signs that we have, potentially turned the corner on that. And if we have done that, that creates room for, much more sort of stable and persistent stock market performance. What I would say what makes this interesting, and again, I'm not trying to be contrarian, but I just think it's an interesting way to look at that, is probably the two biggest policy moves that we've seen this year are immigration restriction and the tariff, liberation day, I guess. And I think the consensus has been that both of those would be inflationary, that immigration restriction would drive up wages and the tariffs would drive up prices because they directly affect the price of the things that are imported. But I think it's at least as likely that those things can be disinflationary. In the case of tariffs, they are a tax. And we can see that the federal government is taking in large amounts of revenue right now from that. That is effectively what's called a fiscal contraction, that the government is taking more money out of the economy, or because it runs deficits, it's delivering less excess money into the economy than it would have been otherwise. Immigration, similarly, while it does potentially put pressure on wages because the supply of labor can shrink, it also reduces demand. There are lots of basic goods that are required for anybody that lives here, housing, food, healthcare, education, and some significant portion of those were actually being subsidized by federal government who's borrowing. And so that effect can be very inflationary. If you reverse that effect and you actually have reductions in demand, then it can have the opposite effect and it can cause easing in price pressures. Both of those things, the best way to think of them, I believe, is as supply shocks. They actually reduce the supply that the economy has, the supply of labor, which is necessary for producing things, and the supply of goods becomes restricted in some sense because of the tariffs, but can also be more difficult because goods that we're importing might be imports into other goods and services that we produce. So that restraint is actually downward pressure on growth. The way that it can become inflationary is if that is met with increases in money to help meet the stresses that it creates. We haven't seen so far. In fact, if anything, people have complained that the Fed may be a little bit slow to ease monetary conditions. So we don't have the monetary backdrop that would necessarily make those things inflationary. They are restrictions on growth, but not necessarily inflationary. And so the final point, this is all sort of speculative, just thinking about what is the real impact of these two policy moves. What you ultimately need to see is what's the outcome from these. And one of the things that I would have expected to see is a reduction in the prices of some of the goods that have maybe had the most pressure built up on them because of the influx of demand that came from, rapid amounts of immigration. And one of those is rents. And rent it's a difficult number to track. One of the things is that it's what's called sticky, because typically people renegotiate rents yearly. So the prices won't change very quickly, even if the supply and demand for shelter has changed and the supply is high relative to demand. But there is some evidence. The Cleveland Fed, for instance, tracks what is the change in new tenant rents over the last year. And that number has fallen significantly. Now, there's lots of caveats around that number because it gets revised. It's a difficult number to collect. And so quarterly, we should expect revisions. But what's interesting is it is consistent with the starting thesis that these two policies may in fact be causing disinflationary effects. There's always forces operating in multiple directions, but to see something that is confirming this potential makes it something that we should, pay a lot of attention to, because if in fact we have sort of passed the peak or past the concerns about inflation, but those concerns are still in the markets, there may be potential for, significant upside coming from that. And I guess that's there's a lot of things going on in macro world, but that's the one that I've been paying the most attention to.
Thank you, Patrick. I think, I just want to caveat. I misplaced you by saying that you are contrarian. I think the real element is, you don't necessarily go with the conventional thinking. And as I was sitting here listening to you, it occurred to me part of the reason why is most market commentators are trained as economists, as opposed to being trained as a historian, which I think you were. And it just gives you a different perspective. Economists tend to think in very structured model approaches, and it limits sometimes their ability to see around the corner. I can say that as a trained economist, but.
Well, one of the things, and Thano has also studied history, but one of the things it will teach you is that anything can happen.
Yeah.
And so you always keep that in mind.
And we do when we build portfolios. That's one of the things we really have to try to keep in mind. So the bulk of everybody's investment exposure is really in equities and in what we refer to as growth opportunities. So let's turn to Thano. As Patrick said, also his background was studying history, but then went on to become an industrials analyst on Wall Street and ran a very successful hedge fund portfolio for Carlson Capital in Dallas for a number of years as well too. So Thano, at that, tell us a little bit what you see happening in the equity market and where you might see opportunities and risks.
Sure. Thanks, John. I think when we came into the year, just to have a little brief history, people were extremely bullish about the opportunity set that the new administration was going to usher in for stocks in general. Obviously, the market and everyone was caught off guard by the the breadth and the extent and the swiftness of the tariffs on Liberation Day. And I think the conventional wisdom and the reason for the sell down in equities was due to the sort of shifting tariff numbers, the amount of people that this would affect, and the concern that it would have to slow down the economy, as Patrick mentioned, with respect to it being a tax. And I think very quickly the market realized, when they realized that there was going to be a pause on the tariffs in general and a more thoughtful approach, and also that the tariffs were unlikely to impact the tech sector, at least for now, and also the pharmaceutical sector, that they could focus on the fundamentals. And I think that it cannot be emphasized enough the importance of the AI trend and the capital spending associated with that. So I'm going to throw out a couple of numbers, because the AI trend does not just affect a few technology stocks. It affects a lot of technology stocks that make up a significant portion of the S&P 500. They also affect a number of industrial stocks that participate in this spend. They affect the energy producers that participate in it, as well as even the financials that benefit from deal flows around this sector. So let's give you some numbers. When we came into the year, the forecast for capital spending on AI was $109 billion, which is a significant number. Right now, for 2025, it looks like we're going to spend $471 billion. That is a massive increase of over $360 billion. Let's put that in the context of GDP at around 30 trillion. Okay, it's over 1%. I try to look back at other examples of what people would consider sort of stimulus to the economy. And if you look at the 2017 tax cut deal in the first Trump administration, I think the assumption that it was going to stimulate the economy by giving a tax cut in the order of $220 billion. So that right there tells you that private industry alone is almost doubled the impact of what the original tax cuts of 2017. So that is, it's extremely good news. It's going to productive capacity, but it does, beg the question, because Wall Street always says, well, what are you going to do for me next year? And it just means that in order to continue to receive growth from that sector, we need to spend even more than $470 billion that we're spending this year. So that's both a positive and sort of a risk. And I think it's why, active managers can sort of sift through where we are on that spending cycle. This could continue for several more years, but even a change in the slope of that curve could be something that the market needs to adjust for a certain, period of time. The other thing I want to mention is the United States is the only game in town if you want to play this trade. Okay, the next closest country that spends on AI is China, and we're 10 times bigger than them. Okay, so that is another reason why I think the market has done a lot better than sort of traditional economists thought in the first half of this year, which is if you want to play this trend, you have to come to America. Having said that, there is a risk, and the risk is these great companies that design these things and do these things are dependent on the fabrication outside of the United States in Taiwan. So let's just take the big ones: NVIDIA, Broadcom, AMD. Yes, those are American companies. Yes, they design the chips, but they don't make the chips. Intel does not have the ability to make these chips. These chips are made by Taiwan Semiconductor in Taiwan, along with the help of hundreds of other critical component manufacturers. So in that regard, if you were looking for a geopolitical risk, and I'm not saying this is going to happen, but I don't like thinking that it could, is if China, for example, were to decide that they were going to take Taiwan and they succeeded in doing that, then much of the U.S. economy would be in the hands of Premier Xi. And I don't think the market would be very happy with that. So that's a geopolitical risk. I think that this administration is moving as fast as it can to remove that risk. The best example is what they did with materials processing, which is a Department of War deal. I think it was Department of Defense when they cut the deal, but the deal was to essentially provide a pricing floor for us to produce and refine rare earth minerals and to produce them into the key magnets that we need, not just for certain engines that we would use in electric vehicles, but things that are even much more important to national defense, like the F-35. That, for example, the F-35 strike plane, I think, uses 900 pounds of rare earth metals. So that was something that the Department of War was saying, that we cannot just be at the whim of China with respect to getting those. And if anybody wants to read about that, it's readily available, but it's a very, very good deal that the United States did. I think they want to do the same thing with high-end fabrication of semiconductors. I just don't think it's going to be a year or two to do it. I think it's going to take several years. And so until we get there, there remains this outside geopolitical risk for the markets in case there's a conflict. Having said that, the other geopolitical risk besides something in the South China Sea, I think, would be an area that I had not given much credence to, which is Eastern Europe and Ukraine. And the reason is, it's appeared to me that the administration was fairly neutral in this conflict, that they were trying to negotiate a sort of an end to it, and that the winner of that war would not materially sort of impact what the United States did. In the last week, this administration seems to have taken a much stronger position vis-a-vis Ukraine. They are giving them long-range intelligence for targets deep into Russia so that they can strike oil refineries and other key choke points of their pipelines. This is the money flow for Putin, and obviously, if you're Ukraine, this is what you want to see having done that. Does this matter so much for the markets? It doesn't, okay? Unless the help that we give Ukraine turns the tide enough and Russia does something provocative. In the last 2 to 3 weeks, we've seen Russia fly drones over Poland, Romania, Estonia. All of those are NATO allies. We've seen MiG incursions over Poland. We've seen electronic jamming of the president of the EU's plane, which forced an emergency landing. And we've seen a number of drones as far away as Denmark. I was a European history major, so why does this matter? It actually is relevant all the way over to China, because I believe that Putin is testing our resolve in NATO, NATO's resolve, what they will do. Trump recently mentioned that they would have the right to shoot those planes or drones down. We will have to see what happens there. But the idea is, if Putin softens Article 5, which is the mutual defense pact the United States has relied upon when we invaded Afghanistan and Iraq, if that resolve is not there, then that raises a question for our allies in the Pacific, how serious our resolve is, which may make China willing to be more aggressive towards us there. So it's all sort of connected. I don't think that these things are serious issues, for the market. I just raise them as something that could derail a pretty nice bull market that we're in right now. And it also reminds us why we want to be diversified in things like fixed income, as well as our gold positions and things like that.
Thank you, Thano. That was most provocative in terms of thinking. And it does go back to this idea that we have to think about the whole portfolio and where all of the risks and where the opportunities come from. As Rodrigo mentioned earlier, we've seen a pretty robust year from our long short equity opportunities. We've seen a robust in our growth oriented equity people. Clearly, the AI trade is helping there a lot. But when he talks about people battening down the hatches, what he really means is some of those long only equity managers are out there trying to search for very deep value type situations with high repeatable cash flows and very strong balance sheets in order to weather any of those potential storms that could come up. One other thing I'm thinking, just in closing, that we will be soon working on our forecast for 2026, and what we think of, where we think the bull bear and where we think portfolios should be positioned through that time period. When we think about that, we also think about what the potential tax implications are of making any changes, and we think about where the relative opportunities are as well too. And that all drives it. But it's great to have the type of input that we have, and we're always open for discussion. We're glad to hear what our investors think as well too, and we welcome your input too. So in closing, let me thank you all for joining us. Let me thank the members of our team who put a lot of work into preparing for this as well too.